I
Once
know
you're
it.
dead, your property passes on to your children. The basis steps up,
Correct.
so they actually get it tax free.
Correct. And if they sell it right away, they won't pay any tax. The only time they would pay tax is if they held it. If Dan was here, Dan McCabe, he'd say, defer, 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 and die.
Yeah,
That's, yeah.
defer and defer. Hi, everyone, and welcome to the Total Wealth Academy video podcast. I'm your host, Steve Davis. I'm the CEO over at Total Wealth Academy and the lead consultant or mentor here at the club. And I try to bring you information that will make you a better investor. And this particular piece of information has saved people literally billions of dollars across the United States over the years because real estate investors pay pretty much the lowest taxes of any for-profit group in the U.S. And with me today is LuAnn Blough, and we're going to talk about one of the reasons that we use real estate. It's not just because it makes a lot of money. It also allows you to keep your money. And there's two ways primarily: depreciation and the 1031 exchange. Now, most people understand depreciation. I will not spend much time on that. I will do a podcast on depreciation here in the near future. But I want to talk to LuAnn about the 1031 exchange. I want to take an example. Well, first off, let me welcome LuAnn. LuAnn, thank you so much for coming on. I appreciate it.
Thank you for having me. Good to see you again. And I'll
Good.
see you on the 20th in Dallas for your vendor night. I signed
Oh,
up for that.
okay.
So, yeah.
Yeah, she is in Dallas, but I want to make sure that people are aware that she can help people across the United States. There is no limit. She can help people anywhere, anytime, do a 1031 exchange. Now, I want to give a simple definition of it, and then I'll let LuAnn give a more complex definition of it. But let's say that you buy a 28 unit apartment complex, a 30 unit apartment complex, and you rehab it, get it leased up, get it stabilized, and over a 2 or 3 year period, you have got this thing up to 90%. Maybe you bought it at 60% occupancy. Now you've got it at 90+% occupancy. You've completely rehabbed the exterior, and the value of the property has increased by $2 million. $2 million. So you sell that thing and you make $2 million at the end of the third year or fourth year or whenever. Do you owe taxes on that $2 million? The answer is yes. Do you have to pay those taxes? The answer is no. You can defer those taxes using a 1031 exchange. Simply put, you just take that $2 million and go buy a bigger piece of real estate. And it does have to cost more than the piece of real estate that you sold, but I think only $1 more. And you can keep that $2 million working for you and your family. Now, I use the word deferred. Yes, it's not tax free, it's tax deferred. But here's the wonderful thing: if you do this correctly, you can actually defer those taxes till after you're dead and
And
hug your
then they
kids.
go away forever.
And then they go away forever when it automatically pretty much goes to your kids. So LuAnn, if you would explain what you do and how you help people achieve the 1031 exchange. What are the requirements of the 1031 exchange? What's all the information somebody needs to know?
Well, that's a lot.
Yes.
Um, 1031 exchange has been around since the 1920s. The IRS put it in place to get more money in the real estate market. So Steve is right. When you sell a property that you've got gain on, we need to figure out what the cost basis is in the property to really find out what your tax rate could be. For that apartment complex, actually, they could owe more tax than on the 2 million because you have to take the original purchase price, add the capital gains, and subtract the depreciation. And whatever that number is your basis. And if you sell it, then you're going to pay taxes on the difference between your basis and your sales price, but you can deduct your seller paid commissions. So you would pay in Texas, we're fortunate not to have a state income long-term capital gains tax. So you would pay 20% on the gain, 25% on any depreciation recapture. That would be your tax hit without the 1031 exchange. In other states, like our friends in California, they also have an 18.4% state capital gains tax. So you add that to the 20, you're looking at almost 40% of your gain plus the depreciation recapture in taxes. There's 6 states in the country that don't have state capital gains tax. So what the 1031 exchange is, it allows you to defer that tax by purchasing real estate that's worth your sales price minus the closing costs or greater, and that can be split up into multiple properties. So there are 6 rules to the exchange. I added a seventh because I'm getting lots of calls yesterday and today saying, I want to sell my property and we're closing today. I
Ah,
say, okay, we can get it done. Um, but had they closed and the money went to, so the 6 rules are you have to have bought a property for business, trade, or investment. You have to hold it for at least a year and a day, or prove that your intent when you bought it was for long-term capital gains. So sometimes you'll buy that apartment complex, you'll own it for 6 months, somebody will come in and make you an offer that you just can't refuse. In that scenario, you want to make sure that the buyer says this was not a solicited property, just in case you ever get audited.
gotcha.
So business, trade, or investment, and it's actually the United States plus Guam and the U.S. Virgin Islands. There was a senator in New York named Charlie Rangel. Does that name ring a bell?
Yes.
Back in the 70s, and he owned a boatload of property in the U.S. Virgin Islands. So basically, he wrangled to add that. No Puerto Rico, which makes people sad, but not yet anyway. So that's excuse me. That's number one rule. What we do as a qualified intermediary, and you have to hire an independent third party to facilitate the exchange, and that's our role. So I spend a lot of time on the phone consulting with people, talking to people. We set it up through a title company so that the money, and we set up a 1031 exchange bank account for people. So when you close, the settlement statement is documented that you are doing an exchange, that the money is going to your 1031 exchange. So you don't, I mean, you can pull some of it out if you want. It's called boot, but you're going to pay tax on whatever you pull out. So investment, you have to set it up before closing. That's my added rule. Number two, you have to have held it for business, trade, or investment for a year or so. Number three is once you close, the date on the settlement statement starts your 45 days to identify what you want to buy. So it's 45 calendar days from the date on the settlement statement. And you can identify up to 3 properties with unlimited value. So if you sold a property for a half a million, you could identify 3 $2 million properties and put that money down towards those properties. If you go over 3, there's something called the 200% rule that kicks in. And what they do if you identify more than 3, we have to add up the value. Say you identified 5 on that 500,000 property. The total value of all the properties you identify could not cannot be greater than 2 times the sales price. So that's
Mm,
$1 million. So anybody out there thinking about this will have to go over it again because it's probably the most confusing rule in the exchange. Um, so there's that. And then there's the 180-day rule. So you have to close on one or more of the properties within 180 calendar days from the date on the settlement statement. So the 45 and the 180 run concurrently.
okay.
And then you have to, well, you don't have to, but to totally defer the tax, you have to buy something equal or greater than the sales price, minus your realtor commissions, title fees, whatever comes out of the proceeds. And then the rule that is really important, especially with what you do, Steve, is the taxpayer ID. So whatever taxpayer ID shows on the sale has to be the taxpayer ID that shows on the purchase.
Understood.
Yeah. So those are the 7 rules. It's just starting.
Well, there's a lot of talk, especially over the last couple of years, about them doing away with the 1031 exchange. That is just not going to happen.
No, there's
Our
too many
legislators
people.
all own massive amounts of real estate. They're using that 1031 exchange probably on a yearly basis. They're not going to let that disappear.
They are not. Every time we have a change in administration, it comes up. But there's way too many people in the government that have made so much money. And there's a group of 1031 exchange accommodators that are in Washington. It's a focus group to keep an eye on that kind of stuff. But gosh, it's been in existence over 100 years.
Yeah,
So
and it really does help the country grow.
it does. It
It,
gives jobs to all kinds of people, maintenance people, rehab people, contractors. It gives people a place to live too. People who can't afford a house, well, they can afford to rent. So
yeah.
yeah, it's important. I've
Well,
been
let's
doing
talk
it 12
about
years now.
the tax deferred till after you're dead. But once you're, it's so much fun to talk about this.
I
Once
know
you're
it.
dead, your property passes on to your children. The basis steps up,
Correct.
so they actually get it tax free.
Correct. And if they sell it right away, they won't pay any tax. The only time they would pay tax is if they held it, say, for 5 years and it went up in value.
Went up
Then
in
they would
value even
pay,
more.
yeah, they'd pay tax on the difference between the value when they inherited it and the value when they sold it. But the tax that mom or dad would have paid, it's gone forever. That's the beauty of the stepped up basis. If Dan was here, Dan McCabe, he'd say, defer, 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 and die.
Yeah,
That's, yeah,
defer and defer. It's kind of like the discussion right now about get more debt, get more debt, get more debt, and die. Same thing with
exactly.
deferring your taxes. Defer them, defer them, defer them, defer them, then die, and it's all
I think I
gone.
like that better than getting more debt, don't you?
Well, if it's income producing debt, I actually like it.
I
I
bet you do.
I don't want any consumer debt,
No,
cars,
no.
personal residences, credit cards, things like that. But buying an apartment complex, going into debt on that, yeah, I got no problem with that.
Right, exactly. Exactly.
So tell us a little bit about your company. How can people get in touch with you?
Okay. And then we'll talk about reverse exchanges too,
Okay.
if you want to. So I am in Dallas. I work for Exchange Resource Group. They are in Denver. I work for 5 real estate attorneys. I think 5. I think they're all attorneys. Dan McCabe has been doing exchanges for 50 years. He is a real estate attorney, and that's what he's done. And Drew McCabe is his son, and he's our president. And then we have me in Texas, we have a office in Florida, and we have another office in Colorado. So to get in touch with me, you can call me at 972-863-1031. My email is my name, LuAnn, LuAnn at ERG and then the numbers 1031.com. I also have a Facebook group called 1031 Exchange Assistance. And we've got over 3,000 members on that. We don't let
Wow.
people buy or sell, but we discuss different exchange scenarios that come up. I think
Okay.
that's,
And the
yeah,
website is again erg1031.com.
correct.
erg1031.com. And we will review that before we finish this podcast. So if you missed it, we'll get it out to you one more time. Yeah, let's go ahead and talk about the reverse 1031.
We're doing a lot of them, a lot more than I remember doing in the past several years. So let's say you found a property that you just had to have and you wanted to sell. Say it's a multifamily, an apartment, and you own single family. Say you own 3 or 4. You have two options. You could try to sell the three or four before you buy and do a straight exchange. Or with a reverse exchange, what we do is we form an entity, an LLC in the state that you're buying in. We borrow the money from you or from you and a lender. We actually take title to that property on your behalf, but you are the guarantor of any loan. If it's cash, then you put up the cash, and that gives you 180 days to get your property sold. Once you get your property sold, the money goes into your exchange account, and then you get it back. So the whole thing has to be completed within 180 days. That's your regular 1031 exchange. Say you find a property that you want to buy, but it needs rehab. Once you take title to a property in the exchange, we can't send any money to rehab. But with the reverse, again, we take title to it on your behalf. You have a construction loan, however that's worked. We send the draws for the construction. You have 180 days to get the rehab done. So that way you can spend that money on your rehab. You could also do a new build, but I recommend that you don't because they rarely get them done in 180 days. And that is a problem. If we bought land on your behalf and you wanted to build, you don't have government permits, you don't have the roads, you've got to put all that kind of stuff in. That can be a little bit tricky.
Yeah, that's high risk to get something like that done in 180 days.
Yeah, it is. So that's the reverse. That's a very simplified explanation of a reverse. We have a whole PDF brochure that I'll send you, Steve, too, on reverses and on the straight exchanges.
Now, is there a way for them to register for a newsletter or anything at erg1031.com?
Send me an email and I'll put you into our. Do you get it? I think you get it, don't you?
I get it
Yeah, we'll
now
put
that
you
I
into
think
our
about it.
system. We'll put you into our system, and then that automatically, we do a monthly newsletter on some topic about the 1031 exchange and schedule of classes and whatever is coming up that we do. If you're in Texas and you're a realtor, I teach a 1 hour CE class. I can do it in person. If you're in Dallas, I can do it Zoom and you can get CE credit for it.
Oh, that's awesome.
Yeah.
Okay. So again, to reach out to LuAnn, it's LuAnn,
Hmm.
correct? At
Correct.
erg1031.com and just ask about the newsletter. And you can, of course, ask her any questions because I know I'm keeping this particular podcast brief because I want you to reach out. It is, while our examples are simple, every 1031 is different. Every person is different. Every scenario is different. And you need somebody on your team like LuAnn to do these things effectively. So again, her email is LuAnn at erg1031.com. And just again, ask for that newsletter and ask any other questions that you might have. LuAnn,
Root
is there
for the
anything in
Commanders.
closing that you'd like to share?
Root for the Washington Commanders.
Oh,
My
yeah.
young,
Your son is the
my
coach there, right?
He's the quarterback coach for the
Quarterback
Washington
coach.
Commanders. Yeah. Yeah. He played in the league for 5 years and then decided it was time to save his body. So
Yeah,
he
that
is
is a
coaching.
rough on you.
It was
No
a rough on
doubt.
his it was a rough on his mom having to watch it.
Okay, well, LuAnn, thank you so much for coming on and explaining the 1031, the reverse 1031. And people reach out to LuAnn, get on that email list, and start learning about this because, again, real estate investors pay the lowest taxes of any for-profit group because of the 1030. One of the reasons is because of the 1031 exchange. So when you're sitting there and you're making a bunch of money off of your single family homes or your little apartments or your big apartments, self-storage, senior living, whatever, make sure you reach out to LuAnn when you sell that thing. See if you can pull off a 1031 and defer the taxes till after you're dead. All right. Thanks again, LuAnn.
Thanks, Steve.
All right. Take care.
Bye bye. Bye bye.